Hi everyone, welcome to the channel. Today we're going to be looking at the company Berkshire Hathaway, ticker BRKB. This is Warren Buffett's and recently passed Charlie Munger's renowned conglomerate with wholly owned subsidiaries across diverse sectors such as insurance with Geico, railroads with Burlington Northern and Santa Fe, and energy with Berkshire Energy. Also, Berkshire has major investments in other companies, owning almost 6% of Apple, about 9% of Coke, and nearly 21% of American Express, to name a few. In this video, we'll look at Berkshire's financials, perform a stock valuation, and at the end, we'll go into computer modeling to forecast the 52-week stock movement. But first, since this is a stock that I do own, we'll look at my purchases. So let's jump right into it. So here are my most recent purchases into Berkshire. It was back in 2020 and beginning of COVID in March, and then again in May. So that initial buy-in 176, almost 177, and then the one in May 189. And since then, we can see the gains in the stock price, 101% and 88%. So down below, we can see the stock is currently trading, at least as of earlier in the week, $355. Now, if I were to put the money into the S&P 500 ETF during these 2 days, I would be up 90% and basically 62%. So overall, these two investments here at the top for Berkshire are up basically 100 or just slightly over 100%. And then the S&P, taking into account dividends, is up 98%. So though I'm up on Berkshire, it's only a couple of percentage points over what the S&P has been during the same time. But down below, you can actually see my overall investments into Berkshire. I've probably been investing in the company about the last 8 to 10 years, I would say. And you can see my overall investment is about 115,000, and the that overall investment is up again just over 100%, almost 107%, with a current valuation of almost 239,000. All right, so with that, let's move on and we'll look at the financials. So first thing I want to point out is this far right-hand column, so trailing 12 months, so taking into account the first 3 quarters of 2023 and Q4 of last year. Also, this top row for revenue, this also is taking into account unrealized gains or losses. Now, one cell in particular I want to point out first is here on the net income line, particularly for last year, 2022. You can see it's negative, almost negative 23 billion. Probably a little bit of a surprise for Berkshire. However, this takes into account unrealized losses. So any of their investments, like in Apple, Coke, American Express, whether if they go up or down in their stock valuation, Berkshire has to take that into account. And last year, 2022, the market was down at the end of the year, especially like Apple was at one of its lowest points for that year. And so that's all taking into account for this net income. But overall, we can see that these data points have been trending upward over the last 10 years. Yes, they had a couple of down years. You can see those in red. But overall, from 2014 to the trailing 12 months, these data points have ticked upwards. We can see here revenue going from just under 200 billion up to over 400, and net income 20 billion, basically going up to almost 77 billion. We can see, some of these points were higher previously. Right here, say net income in 21 was almost 90, and again just over 80 in 2019. So the trailing 12 months, not necessarily the highest data point over the past 10 years, but definitely higher than it was 10 years ago. We can see here dividends. Berkshire does not pay dividends. But share count, this is one thing I like to see, is share count going down. And we see over 10 years, it's down probably about 10% from 2.4, almost 2.5 billion to just under 2.2 billion. And then book value going from about $98.60 up to almost almost $200 a share. So book value greatly increased, nice sign. And then free cash flow, we see they've been free cash flow positive for all these years. Even during COVID, they were free cash flow positives. So that's a nice sign to see there. One other data point I like to see is net profit margin, which I like seeing over 10%. We can see typically they are. Last year showing negative because it had negative net income, but then 2018 was just under 2%. But besides from that, over 10% and really up around that 20% mark for most of these years. And then return on equity is typically another data point I like looking at, but Berkshire, it's a big conglomerate, so a lot of different companies, so it's hard to really pinpoint what their return on equity can be. Railroads typically has like in a 30% range. They're in insurance. Insurance is usually a lot lower, so it's kind of hard to really identify what their uh, average return on equity should be for their industry. But I would think it should have been at least in the high teens to around 20%. They had those that data point a few times, but we can see typically it's been lower than that, and a lot of times in the single digits. But let's move on and look at some other data points on the graph. It's a little easier to see. So on this graph here, what I want to see are these data points going up and to the right. So the first one, revenue per share in white, we could see back in 2014, probably around $80 a share. And now it's up to just under $200 a share. So more than doubling over the past 10 years. It does show the down year back in 2022, last year. That's when they had the negative net income, but a nice recovery since then. And then book value per share. See, back 2014, about $100, and now up in the $220 range. So again, more than doubling over the 10 years. So I'm going to remove those two lines so we can see some of the other data points a little easier. Next, we'll look at in green earnings per share. And we can see back in 2014, probably around $9 a share. And this has been a little choppy though over the last 10 years, but trailing 12 months, it's up over $30 a share, probably around $35 a share. And we can see that drop from last year when they had the negative net income. So let me remove earnings per share, and then we can look at the free cash flow per share a little easier. And that leaves free cash flow per share. We can see back in 2014, it was probably around $7. But since then, it has jumped up to just over $12 a share. So not quite a double, but still probably in that 70 to 75% gain over the last 10 years. So you see a lot of these data points, or all these data points, have moved up and to the right. Something I really like to see here. Now, let's go down. We'll actually look at the valuation for Berkshire. With Berkshire being a large conglomerate, there's different ways you can value the stock, but I'm just going to use the discounted cash flow method. And my initial setup here has the short-term growth rate 10% over the next 10 years with a 10% discount rate. And that comes out to an intrinsic value of $264. Then taking into account a 90% margin of safety, it drops the price down to just under $238. Now, the stock is currently trading in that $350 range. And looking up here, we can see the net income for the last 10 years. It had catered at just over 16%. So I'm going to change that growth rate from 10% to 12%, just being a little more conservative than the prior 10 years at 16. And we'll see how that impacts the stock, which has been updated here. So now we got that 12%. And we can see the intrinsic value has jumped up to $310. And same thing with that 90% margin of safety brings it to $280. So at this point, I'm just holding on to Berkshire. If the stock does drop, getting down in this range from 280 to 310, I will consider buying back into Berkshire, as I feel it is a good long-term investment and an alternative to investing in the S&P 500. And some other data points I like to look at are up here. Typically, I like seeing these 10% or higher, but we can see for Berkshire, earnings per share is the only one they achieved that over the time periods listed. Sales, pretty close. We can see just back over 10 years, that growth rate has been in the high single digits, just over 8%, but all the other time periods over 10%. Let's scroll down and look at some other data points. So PE ratio just under 9. So it is in that value opportunity. So if somebody's going to value Berkshire and have a higher price target, I can understand that. I'm typically a little more conservative with my valuations. Then moving on, long-term debt to free cash flow, 4.5. So a little higher than I like to see. Typically like to see 3 or lower. We know Berkshire doesn't pay dividends. Share count, we see almost minus 12%. We saw that earlier. They've been buying back shares. And then net profit margin, as I mentioned, I like to see over 10. See average over the past 10 years, 13%. In the last 3 years, 12.5%. So not too bad, not the greatest data points, but not too bad. And I do think Berkshire is a nice alternative to the S&P 500. And I know Buffett tries to beat the S&P 500, so that's one of the reasons why I invest in Berkshire. And it's typically a pretty safe bet, but you just got to buy it at the right price. But let's move on and we'll look at the 52-week outlook for the Berkshire stock price using computer modeling. Here in the computer modeling, I already ran the analysis using two methods. First, the M5 rule shown here, and then random forest. So I'll point out this is as of this prior Monday, December 4th, and the far right-hand column is the stock price. So it closed at around $353. And the column right next to it is just the S&P 500 ETF, and other columns are just other various data points used for the analysis. Now, I did take all these results and pasted it into Excel, and we'll go over there in a moment. It's a little easier to see on the graph, but I'm just going to scroll down to 52 weeks just to see what the initial outlook is for Berkshire using the M5 rule. You can see here, December of next year, it's actually showing a nice little gain for Berkshire going up to $428 using M5 rule. But let's jump over. We'll go to look at random forest, then we'll go over into Excel. So same thing here in Random Forest, stock price closing at that $353 range this past Monday, and scrolling down the 52 weeks, we can see the outlook using Random Forest. It's actually showing slightly negative out in December of next year, closing at just over $343. But let's take this information and we're going to look at it on a graph in Excel. So we have all the data moved over from computer modeling into Excel here. And first thing I'll point out is this vertical red line that represents this prior Monday, December 4th. And everything to the left is the historical stock price in blue, and everything to the right is the forecasted. And just looking at a little history of the Berkshire stock price, we see back in 2009, it was probably trading around $60 or so. And we can see since then it had this nice gradual run up, slight decline in 2020 during COVID, but then nicely recovered and actually getting over $300 in 2022, but then dropping off towards the end of that year. As I mentioned earlier, the market did have a decline at the end of 2022, but again, recovered to where we are now at that $350 range. Now, I'm going to jump over to another tab where we can look at the two forecasts and the average of the two a little closer. So first we'll look at the M5 rule, and we're going to focus on everything to the right of that vertical red line. And we can see the initial outlook going into 2024 is actually a slight decline in the stock price, getting into the low $300 range. But then starting to recover probably March, April, and the stock continuing to increase throughout the remaining of the year for the most part, and actually forecasting early December of next year, the stock getting into that high $420 range, almost touching $430. And if this does play out as shown, that would be a gain of about 21% from where we are today. So a nice little return for 1 year. But let's move over, look at Random Forest. As you recall from the computer modeling, that was a little more bearish of an outlook. So Random Forest is also showing that decline in the stock price going into Q1 of next year. Though it does show a recovery, it's not as steep of a recovery like we saw in the M5 rule, and actually doesn't even showing the stock getting back up to that $350 range. It's showing more of the stock just leveling off in that $330 to $340 range, and closing out beginning of December of next year, actually slightly above $340. So if this does pan out, that would actually be a drop in the stock price from where we are today of about a negative 2 to 2.5%. But now let's go look at the average of these two methods just to get an idea. So obviously for the average, it's going to show the initial stock price drop going into 2024, but then recovering and looking out into December of next year, it does show recovery, regaining those losses and actually forecasting $385 range for Berkshire out in December of next year. And if that does play out, that would be about a 9% return from where we are today. Before recapping, I would like to give my thoughts on Berkshire paying a dividend, which Buffett currently maintains a no dividend policy, as he prefers redirecting that capital to investments for better utilization rather than a payout. Also, Buffett views dividends as tax inefficient due to a 15 to 20% federal tax coupled with a potential state tax. And with Buffett's potential successor, Greg Abel, working under Buffett's guidance for the last 2 decades, the likelihood of Abel also paying out a dividend is highly doubtful. So don't be expecting a dividend in the next 20 to 30 years, is my outlook. But ironically, the company does receive substantial dividend payments in the billions from the companies Berkshire invests in. And as a side note, Berkshire did pay a dividend back in the 1960s once, and Buffett likes to joke that when the board took that vote, he left to use the restroom, but in fact, he was there. To recap, Berkshire has been a stable performer with a stock price steadily increasing over time and is a long-term investment for me. And when looking at the computer modeling forecast, it does show the stock dropping into Q1 of next year, getting into the $300 range, which I would consider buying as it would be around my valuation price. But then recovering, and for the random forest, showing that stock getting up to $340, not quite where we are today. But the M5 rule showing a nice 52-week return with that stock price recovering and getting up to the $430 range, which would be about a 20% return for 1 year. Now, hope you enjoyed the video and got some useful information. If so, consider subscribing, and I'll see you next time.